Well, hello. Thanks for joining us. This is Anthony Parent of IRS Medic. With me is John Richardson. John, good morning to you. We are about to embark on expat tax preparation Q&A part 2. You ready for this?
I am ready for this. Yeah.
We are waiting for Keith to join us. We'll patch him in as soon as he's here. But we want to get going. We got a bunch of questions that have been asked since the last time. We want to get to those. So let me get our first question up. This is a Canada question for you. Ooh, this is exciting for you. I have lived in Canada since 1985. I have never filed a U.S. tax return since moving from the U.S. I ran a small business until 2016, which didn't bring in enough money to be taxable. From 2017 to present, my income has been nil. That is about to change. In a year or two, my husband will be splitting his income with me once he retires. I may come into some inheritance, and we may sell our home, which is in both our names. I want to become compliant before that happens, but I'm unsure about how going to do that in the best way possible. Am I required to file even though I don't have an income? How many years should I back file? Does the streamlined procedure apply in my situation? Would it be advisable to have a tax professional to walk me through the process? All right. So, the first thing that points out to me is the one thing that it is her. This is and I don't have her name. This was from somebody, one of Keith's friends. He forwarded this to me. So the first thing that I look at where I'm like, what's that about? Is she ran a small business until 2016. That is what I have a question mark about, because if there was a 5471 due, all right, and hey Keith, we started in, and so we are on to our first question, and it was the one that you forwarded to me from Canada
just today. Okay, good.
We're on that, and I just read the question, and so now we're going about answering it.
Okay.
And this is, and that I started focusing on the third sentence. I ran a small business until 2016, which didn't bring in enough money to be taxable.
Yeah.
That is pretty much my only concern in here, because there could potentially be a Form 5471 due for that.
How would that be, Anthony? Just because it was a 2016, and if she enters the streamlined program, it won't go that far back.
Exactly. But there is the exposure for the 2000. There is the exposure on the 2016 if there happened to be a Form 5471 due. Because as I look at the rest of the question, I'm not sure she would actually need to do a streamlined. I'm not sure she would actually have to do a streamlined. But if she did do a streamlined, then she wouldn't need to worry about any 5471s going way back, because what the streamlined does is all your ancient history of forms that you haven't filed, it takes that out of the IRS coming back to penalize you for it. I am talking a very small chance of anything happening, but people kind of want a little bit more protection than the small chance sometimes. And I have seen it done. I have seen it where IRS revenue agents will go and assess multiple years of 5471 penalties. I had a case in 2017 or 2018 where the IRS went back to the year 2000, and they assessed the 17 5471 penalties. So that is something there. It's a small risk, and now there's a recent decision that say those penalties aren't something the IRS can assess easily. So the same risk might not apply, but that relies upon the IRS actually following the law.
Hey, Anthony, let me ask you something. And again, I'm Mr. Layman on this. So how would they, I just don't know. That's why I'm asking. How would they even know about what occurred in 2016 if she does a streamline? How would the IRS have any clue that she had a business in 2016 if she's never been in the U.S. tax system?
And that is exactly, that's a fantastic question. And I could just tell you the way that in the case that I took where the IRS assessed those 17 5471 penalties, the IRS got that information from a Swiss bank that was under criminal investigation. So the Swiss bank coughed up all of these records.
There was a Swiss bank. Okay.
There was one piece of paper with my client's name on it, and so they just went hog wild on that. We didn't know
that's very special. Switzerland is a special case.
And I think that also could help answer the question, because how would, I'm going to assume that if there's, a bank involved or anything like this, or maybe there's not even much of a bank account involved, there's not really any way that information would wind up in the lap of an IRS examiner. So that is that's really my concern, is just the 5471. But if you don't if your income is below certain thresholds, you have no filing requirement. I am not sure if she has any signatory on any bank accounts that are over $10,000 in the aggregate. That's the one thing I don't know.
Yeah.
And if she's living, this is sort of my general stance on Streamlined. If you're overseas, why not use the Streamlined program? Because you get additional protection and there's no penalty associated with it.
Yeah.
When you're living in the U.S., okay, you might want to kind of maneuver things to try to avoid that 5% penalty.
Right.
But if you're overseas, you don't have it. So why not go full?
Right. No, I hear what you're saying. Here's the thing, though, and tell me what you think about my line of thinking here.
Mm-hmm.
So, and I'm just speaking generally, okay? So you do the Streamline program as an American overseas, and you're not doing it because you want to renounce. You're doing it because you want to get right with God, okay?
Okay.
So it's not done in a vacuum. So do these people know that every year afterwards they're going to have to continue to file? Regardless, as they're starting to accumulate wealth, if they're, opening up other investment accounts, etc., that they're going to have to do this every year, and it could get worse for them every year moving forward. And I don't think I'm not saying not to do the Streamline, don't get me wrong, but I think people need to take into consideration what the future is going to look like when doing it. Would you agree?
Yeah, and I 100%. People that oftentimes people make a Streamlined disclosure, and then very quickly, the next year, the following years aren't in compliance, and that's what we're seeing a lot of people calling us. They did a Streamlined, and then things went. What happened there? So that is what's going on. That people aren't realizing. Okay, you're doing this, but understand what you're doing. You are now fully in the system, and now you've made a statement to the IRS that you know what it is to be in compliance.
Right.
You said, "Oh, well, now I know I'm aware of my obligations," and now you really want to make sure that you're doing that. So yeah, you want to be aware of what you're doing. I think in this case, it does seem like something where there is a little bit of risk here. She's going to be, she is going to have. I'm not sure how this splitting his income with me when she retires. And I'm not sure what that exactly means. Now she says she may come into some inheritance. That isn't necessarily anything that would, if this is the thing, if that's a U.S. based inheritance,
right,
you would probably want to take care of it, because the IRS can easily, intercept that if they find you not in compliance. John, what would you have to say about this here?
Okay, I don't think there's enough information to provide a lot of any specific advice, and even the general advice is difficult. First of all, it says ran a small business until 2016. That's past tense. So we don't know that anything is continuing. Two, we don't know the form of the business. There's no indication that it was run through a Canadian-controlled private corporation. So it may very well have been just, a sole proprietorship, et cetera. Three, there's been some discussion here on the Streamlined. If, in fact, the business was being run through a Canadian-controlled private corporation, and if there was any transition tax, and if it existed at the beginning in 2017, if there's a transition tax issue, remember the Streamlined procedures specifically require that to be accounted for as well. Okay, so the issue of how the business was run here is absolutely critical. If in fact there was no small business corporation, or if it doesn't exist anymore, or something like that, or if it had no retained earnings, it's probably not a big issue. Two, the question says, my husband will be splitting his income with me once he retires. I understand that, given that this is coming from Canada.
Okay.
I understand that to be taking advantage of a filing mechanism under Canada's tax laws that allows a married couple to split income. But that's a purely Canadian thing. That's absolutely not receipt of income for U.S. tax purposes at all. Okay, that's just the way the husband's income is taxed in Canada. So that should not be an indication of receiving any income. Third, my assumption is that if she's filing at all, she'd file married filing separately. Since the Tax Cuts and Job Act, incredibly, anybody using the married filing separately designation is required to file a tax return even with zero income. Okay, however, the IRS in its graciousness has raised that. I'm not sure they have the legal authority to do this, but they raised it to $5. So really $5 of income from any source, even taking a babysitting job or something, would put the person in a position where they're required to file a tax return if they're using the married filing separately exemption, even with basically no income. So, that's of course an issue as well. So I'm referring specifically to the part of the question, am I required to file even though I don't have an income? Okay, so 2 points. One, the use of the income splitting mechanism under Canadian filing requirements does not give her an income, but she does need to understand that if she is going to be using the married filing separately, okay, if she's going to be using that, then as little as $5 of income would require her to file. Now, there's another aspect of this that I think is worth keeping in mind, and that is that anybody who's required to file a tax return is also required to file a Form 8938, okay, the disclosure of foreign financial assets. And the way this question's coming in sounds to me like there may be joint assets with her husband, etc. So this is, of course, IRS direct, reporting her husband's assets to the IRS, etc. On the question of does the streamlined apply, you talked about the streamlined in a general way, but don't forget the predicate for using the streamlined is there has to be actual unreported income from a foreign financial asset. Okay, you can't just go and file a streamlined without something like that. So those are some things to keep in mind. Obviously, I don't see this as a huge problem, but I do think it's worth discussing this with all the relevant facts before moving forward with it at all. I do, though, echo your your concern about the inheritance, and that certainly heightens the risk of the IRS learning about this person, etc. But there's nothing apparent. There's nothing from this that I'm not reading anything from this that is screaming that she's required to file a tax return anyway. Okay, I mean maybe she's not even required to file.
Well, the one thing, if you have a business and you have any revenue whatsoever, you have to file. Even if you have a loss, you have to file.
Self-employed, I think it's $400 or something like that. But you're right. Okay, there's an issue as to whether she has to file. And that's a function of her filing status and the source of her income.
Right, exactly.
Right.
That's what it comes to. Exactly. Thank you, John. Yeah. So that usually what the IRS looks for is 6 years of the last filed returns. And I think we're outside that, at least. It appears we're close to that.
Yeah, sure. Just go back and you can easily go back and file the 6 years if you want. But look, if she's not required to file, she's not out of compliance.
Yeah.
So why is this a concern?
Right. So I think I think what she should do is give she could give a ring to us to contact us or contact someone to just say, hey, do I have a filing obligation to begin with? Right. That would help resolve the issue. And these are what's tricky, right? Well, because when you're in a situation like this, when someone says, okay, you don't have to do anything, that doesn't really sit well, because you're like, well, I need to do something. It seems like you need to do something. But you actually might not need to, and you could be right.
There's not enough information to know. There is a possibility here that there's no tax return filing requirement at all. If
All
so,
right,
she's not out of compliance.
all right. Well, let's move to the next question. This, I think, is going to be okay. This is from a YouTube commenter. I renounced in 2022 and filed the final return in Form 8854 on this past April 1st. As of today, mid-May, the IRS refund check tool shows my return status as return received and still processing. How long does it take for final returns to fully process and show up on your official IRS tax return transcript? The answer is I am not sure. Did you e-file or paper file? Would be the question I would ask. You filed at 8854, so I could see it either way. So I'll answer the question either way. Assume you e-filed. It's probably going to show up in another 4 weeks. That's what I imagine. If you paper filed your return, I just was reading the IRS press release on this that they said we're making huge progress on processing our massive backlog of paper returns. However, we're not as fast as we were pre-pandemic. During the past few years, the IRS has taken over a years to process returns, especially ones that are a little bit later. So it could be up. What I would say is I would probably estimate about 6 months if you paper filed for the IRS to process it. Now, with that said, they might process it, but you might not get the notice that they processed it till 2 months after the fact that they actually process it. So it should be pretty soon. John, anything to add?
I have absolutely no thoughts on that at all.
Okay. Keith, anything to add?
No, not at all.
All right. Next question. This is a good one. This is a good one. Ashley Ellis, she's in Mexico. This is a question from YouTube. I have a question about my kids are accidental Americans because they were born abroad, and I am an American, but not their dad. But I declare them as dependents on my tax returns.
Yeah.
Can they just stay out of the system when they are adults, even though they have been declared on my returns? John, what do you think about this one? So because here's the situation that she put 2 dependents on her tax return and put their social security numbers.
Yeah. So the problem is that they're being identified as American citizens. Okay, that seems fairly clear.
Yeah.
But that does not that would make them subject to U.S. tax laws, but it does not in and of itself create a requirement to file, right?
Yeah.
And a lot of, I find that a lot of, younger people, they go through life and they're students, and this sort of stuff. And, very often it takes them, a good bit of time to reach the thresholds to be required to file themselves. And, I think that's something to keep in mind in this whole thing. I mean, what I would absolutely not do is just rush out and say, oh my God, they've been declared as U.S. citizens, therefore they should start filing. I mean, okay, so there's plenty of U.S. citizens who don't file because they don't meet the requirements to file.
And I don't know if I could really answer these questions. And actually, a lot of the things that at some point we'll have to discuss this, and maybe just to tease on it right now, because I think this applies to a lot of these cases where they're somewhat, like, okay, what's really going to happen? Okay, there's technically some non-compliance, but is it a big enough deal for the IRS to detect it? The concern that I'm having, and I was talking with a colleague the other day, and she was mentioning to me, she says, look, I got to tell you something, Anthony. I said, well, what's that? She said, I do a lot of tax return prep for my clients. I'm like, yep, so do we. She goes, well, I have never seen so many crazy letters coming from the IRS on returns we filed. I go, I'll be honest, I've been seeing some weird stuff too. And she goes, you know what I think's going on? I said, okay, what's that? She goes, I think the IRS has been deploying artificial intelligence, and these things make no sense. We got a letter to say submit all the W-2s and 1099s, and there was information sharing between California and the IRS. Well, we did.
Yeah,
we did. What are you guys doing? And the letter is very, if you got this letter, it's very upsetting, even though there's nothing wrong. And as we said, and this might be something we hammer a little bit more and have more discussion on. But one of the things that I'm concerned about is, as we recall, that it was Commissioner Redding, the past commissioner, who testified in front of Congress to say, yes, we got all the data from these overseas banks for FATCA. However, it's all completely in an unusable form, and we can't do anything with it. And I'm thinking to myself, well, geez, if there was one application that artificial intelligence could help you do, is take that blousy data and then put it into a format that you could use. And so there is my tremendous concern that I don't think.
Whoa, Anthony, I spoke with, as you know, I spoke with my contact.
Oh, you did?
Who,
okay.
Yes, I did. And I'm sorry I didn't get back to you on that. I will later today.
Okay.
But I did pose the question to my contact, who is formerly intimately involved with the IRS Criminal Investigation Division, and he's still intimately involved with dealing with the IRS.
Okay.
He stated that no, the IRS is not up to speed to use AI.
Okay.
He doesn't have a good, I don't mean this in a disrespectful way, he doesn't have a good answer on these weird letters that you're speaking of.
Yeah.
But he said to me, he said, I assure you, they are not using AI. They're not up to speed on that at all.
Right.
So I just wanted to share that with you.
And I mean, it could make sense because they don't necessarily have the architecture in place to use it. And this is just something that, I've learned from years of doing this. The IRS still uses a mainframe. It's still a backbone. Yeah. And the reason why is that they have a bunch of COBOL engineers. And COBOL engineers are fantastic at making sure that they never are obsolete. So that's one of the things that they're fighting. So I guess that's good news for the rest of us, I suppose. John, anything to add on this?
Nothing to add.
Yeah. Okay.
Yeah.
Let's get to the next one. So
I just want to make sure, I'm going to interrupt for a second. Just forgive me. I just want to make sure you have also the question that was raised.
I do.
By
Yep.
Jackie.
I got that one from Jackie. Yep. We're going to.
Perfect. Okay.
Yeah, we'll get that one. Let me get to this one. Okay. Here's a FBAR question. Oh boy, an FBAR question. This is pretty good.
Good old FBAR.
Good old FBAR. Okay. FBAR filing leading to an audit. Oh boy, is this just always a question that I get all the time. What about amending in an existing FBAR? We did include a defined benefit pension with no cash surrender value. Okay, right? Oh God. On the 2021-2022 FBARs. Would including it increase the risk of an audit for the corresponding tax returns? And do we really need to declare this type of account? Just to give more detail, this is for a dual US-UK citizen resident in the UK, so employer contributions are excludable. Retirement is 30 years away. The 2021 and 2022 FBARs were submitted listing other accounts. Only the pension account, which started in 2021, was missing, as we did not know that it was potentially reportable. Our concern with amending is whether it would draw attention to the tax return, which we prefer to avoid. Ursa Sunshine. Okay. So I want to just start off with this one by saying that I am not aware of one tax audit that was initiated off of a filed FBAR. John, Keith, and I think we all agree that an FBAR is only worth something to the IRS when it's not filed.
Right.
So the filed FBAR isn't the grounds for, as far as it is now. This is all subject to change. But when the IRS, they have completely different mechanisms for selecting people from an audit. And that's all from your Title 26, and that's what your income tax is. Call your FBARs Title 31. Those processes in administrating the FBAR penalties is the responsibility of the IRS. But actually handling the receipt of the form, it goes to Detroit. And it says IRS, but it's really a separate Treasury department. So it's really not part of the IRS where your FBAR is going. So I can't say I haven't talked to everybody in the world, but I've talked to a large sample of people with FBAR issues, and I have never encountered an audit initiated off of a filed FBAR or an amended FBAR. That's not what it's used for. I am going to be talking to a a gentleman who used FBARs in his law enforcement career. So I'm going to get some insight from him on how he used FBARs to go after people, but he was in actually going after criminals. It wasn't attack. He wasn't related to the IRS at all. He was grabbing those as an investigative tool as he was, I think he was working for the DEA. I'm actually I have him to come on the show pretty soon. So that should help us get some clarity on that. John, what are your comments on this?
My initial reaction to this is that it's not the type of account that would be included on an FBAR. But I think that, there's only skeletal information here. I certainly would not, regardless of the effect of an amendment, I certainly would not try to amend the FBAR unless a decision were made that it was reportable. I would point out here that it seems to me highly questionable. This thing is called, first of all, it's not an insurance policy with cash value. So, that knocks out that part of it.
Yeah.
Defined benefit pension, that doesn't sound like something that he has signing authority over or control the disposition of it. So my initial thought, and this is not a guaranteed answer, but my initial thought would be that this very well not be something that needs to be put on the FBAR. I would investigate that. But the flip side is it most very definitely is something that should be put on the Form 8938. All right, the information of foreign financial assets, presuming that the person otherwise meets the threshold requirement for that, which, if this is a UK resident, I think would be $200,000 filing single or $400,000 filing jointly. Notice, by the way, that joint filing can reduce the volume of reporting requirements, particularly in the Form 8938 area. And the fact that, talking about the fact that this is not includable as income is completely irrelevant.
Right. FBAR is not concerned with income. Keith, anything to add?
No, nothing to add on this one.
All right.
No.
All right, let's move on. All right, we have, okay, here is a big one here. Let's get to this one. All right. This is PB. She is in Japan. She's been watching us for a while. We appreciate her comments always. My situation: been out of the U.S. since 2004. File taxes consistently. Never made anything close to over the 90,000 to 100,000 USD foreign earned income exclusion threshold. I've always filed 2555 EZ until it was discontinued, then started filing a 2555 in 2019. No savings over 10,000 USD in non-US bank accounts. I do have a pension, but that's through the Japanese government. And that also, again, that sounds like something that wouldn't go in FBAR. I want to get rid of my citizenship because I want to start a business, buy property, invest in Japan. All right. All right. She's going to retire that U.S. citizenship. I haven't done so yet because I know it will be a headache to do so as a U.S. citizen. It's held me back in life, to be honest. Look at this. Huh? Right? I'm hesitant to get rid of my citizenship because my child has dual citizenship and has a social security number, and I have no clue how to travel with her as a minor. To be honest, I don't mind filing the 2555 EZ, but the FBAR is completely insane. I have no desire to live in the U.S. ever again. However, my daughter might want to do so until she's old enough to make that choice. I feel as a parent I should wait. John, what do you say on this one, John?
I'm not really sure what the question is. I mean, it's articulating a lot of things that we know are a problem. I mean, it's very problematic to live as a U.S. citizen abroad, as a tax-compliant U.S. citizen abroad, which obviously is the intention here. That said, I have the impression from this that this person could benefit from a little more of a balanced discussion about, how deep the reach of this stuff is and how much it really affects the person. I mean, you can have property as an American abroad. You can do that. You can start a business You just need to be. It's not ideal. You can, but you want to think carefully about how you do it. You'd want to keep it a proprietorship, I think. I mean, possibly you're going to be subject to the self-employment tax, but you avoid the whole 5471 thing. And you can invest in Japan, but you can't. You want to avoid the whole PFIC problem, which is mutual funds, etc. So you find a way to do it that, perhaps individual shares or something like that. I don't think all is lost here. I think that, yes, there are big problems. We all know that. But if she wants to keep her citizenship, she needs to, I think, understand how to accomplish these things while minimizing, U.S. tax compliance headaches and things like that. I think it can be done. I think she needs a discussion with somebody on how to do it.
Yeah, and I think that reading this, it's just sort of, I feel like, I need to not do anything until her daughter's old enough, and that really might be the, now, and then this is also thinking, you hear all the nightmares from us, but it is possible to be in compliance. It's just enhanced cost. That's really,
and you have, and you have to.
It's higher, but if you have some, and it's a little bit of a more of an enhanced headache, there are certain people who end up in really, really difficult situations. This is more of a headache situation where, okay, we have to file this, and make sure you plan it out right. But this is something you can hang on to your U.S. citizenship and still do all these things in Japan that you want to.
It's an exaggeration. It's an exaggerated state of the fear and the complexity. I think that the key point here is to understand how to do these things, but keep it simple, right? I mean, what do I do to avoid this form or that form? And I think that this can be done. I agree it's not ideal, but it can be done. But I think, when I look at this and I get sort of listening to how you interpret this and Keith interprets it. I mean, I have the feeling this person is wanting to put their life on hold, and that would be the biggest mistake they could make. Okay, here's the deal. Very simple message. Even an American is entitled to have a life.
Right. But here's the thing, gentlemen, and is that yes, I mean, I certainly agree that it is possible to retain your U.S. citizenship and moving forward. But having said that, it's going to add an additional burden that whatever financial action you decide to do, you need to see how it's going to affect your U.S. tax filing, no matter what that action is. So you always have to be vigilant moving forward on that. And so that, for some people, that adds a burden they just don't want to deal with. Or maybe they do. It just depends. But as far as going to the United States with a minor who's an American, I mean, I've dealt with people in that situation, and they have renounced, and they have not had a problem going in. They actually end up going through the non-American line. They present their CLN if it's asked, and the child goes through on their U.S. passport. So it just, it depends on what this gentleman, I don't know if it's a woman or a man, just wants to do and what level of headache they want to have moving forward.
Yeah, exactly. Yeah, thank you. Yeah, thank you for that. This is a situation. Yeah, PB is watching right now, so she's thanking us for answering this question. But I would just say, PB, you could reach out to our firm CPA here, schedule a time with them at IRS Medic. I can get you that link to his calendar to book something with him if you want, and we can go. He can go over all what's required to be right. So you don't have to worry about it. It's just, this is just something where I don't think there's, a lot of these. I think we're used to a lot of situations where you can kind of go online and say, okay, this is what I should do, and this is a situation where you really can't.
Right. And would you say, Anthony, that your CPA would go through the different scenarios, like, okay, this is what it's going to look like if you retain your U.S. citizenship based on what your financial plans are moving forward, and this is what it's going to look like if you renounce your U.S. citizenship, and what that's going to look like moving forward. So that way, the individual can make an educated decision on what's going to be best.
Yeah, but I love John's advice. Just don't put your life on hold. That's
right.
Yeah. All right, I want to move on to the next question. This is one that just came over to Keith, and let me just read it. This is from I don't have a slide for this one. Let me just read it to you. let's see here. Where is Keith? This is from Jackie.
Yeah.
I am a covered expat. If I die in my foreign country of domicile residency, my estate will be subject to the 40%
Inheritance tax.
Oh, okay. Oh, okay. After that is taken from the estate, will my American heirs be further taxed by the IRS at the highest possible tax rate? I am a covered expat, so she's not a U.S. person. If I die, okay. And then the question is, well, I would say to me, it sounds like, well, we have a situation where U.S. persons would be receiving a foreign gift or inheritance, and so it sounds like to me, all that needs to be done is that when that occurs, a Form 3520 needs to be filed by them receiving it. There's nothing that well, you would unfortunately pass, so there's nothing you would do anyway. But they would be the ones with the obligation, because if they don't, and this is the thing, if they don't file that 3520 on a foreign inheritance, there is a penalty that is based on the amount of the inheritance. That is what, 30%, 25%? I get the numbers confused. It's way up there, and it's not a tax; it's a penalty. So, in a sense, that if the failure of the form de facto creates a new tax. So I would say that it just sounds like they would not be your American heirs would not be further taxed by the IRS. There could be inheritance taxes depending on what state they live in. You just want to take a look at that. But other than that, I don't see that there'd be additional taxes imposed upon you. You just want to, and I would just mention this: you want to be careful if you have any now. If you have any assets in the U.S., your assets are subject to the estate tax, and that exemption isn't the $5 million for U.S. persons. Your exemption is $60,000. Then after that, boom, the taxes start in. So that's just something to be careful of. You don't want to own anything individually in the U.S. if you are a non-U.S. person. You want to have a business or trust own it. And often an offshore trust own the asset in the U.S. to avoid that. John, anything to add?
Sorry, would you mind just rereading that question before
Absolutely.
I chime in on that?
Yeah, because I'm confused on one point.
I'm sorry. Yeah. So I am a covered expat. If I die in my foreign country of domicile residency, my estate will just be subject to a 40% inheritance tax. After that is taken from the estate, will my American heirs be further taxed by the IRS at the highest possible tax rate?
Okay. So what's not clear to me is whether the person has renounced U.S. citizenship or not renounced U.S.
Exactly.
citizenship.
Yeah.
Okay. So
Okay.
let me try to take this from 2 points of view, and then maybe you're going to want to add something again. Okay, let's begin with the person remains an American citizen, does not renounce, okay, and dies as an American citizen. So step number one, I'm not sure. I think what the person is saying is that he or she has assets exceeding $2 million, okay? Now, if the person remains an American citizen and dies, then the beneficiaries of the estate are simply going to inherit the assets. You know, I mean, there may be some state as an STATE implication, you know, where they're living, et cetera. That's a separate question. Also, there may be a tax imposed by the country, you know, where the person dies, et cetera. But there's no special tax imposed by virtue of being a covered expatriate because the person died an American citizen, right? I mean, you're only a covered expatriate if you renounce U.S. citizenship, okay? And also, by the way, if the person does not renounce, you know, to your point, Anthony, about filing 3520s and things like that, well, there's no inheritance from a foreign person, right? So there's no, you know, 3520 to file. Now, let's look at this other scenario where the person renounces and is not a dual citizen from birth and has a net worth of over $2 million and therefore is a covered expatriate. Let's look at that scenario. Okay, so the first thing that happens is, from a U.S. point of view, is we've got to deal with the exit tax, right? Which would be a deemed disposition, a deemed sale of all of these assets. So that's a tax that needs to be paid. Then let's say as a non-resident alien, okay, as a non-resident alien, the person continues to own U.S. situs assets. Okay, it would seem to me that unless there's a tax treaty in place, and if the assets are over $60,000, it would seem to me that you've got an estate tax issue on the U.S. side, right?
Mm-hmm.
And then we have finally to deal with the issue of, is there a tax payable by the ultimate beneficiary? And I think we need to be mindful of, I think it's section 2801 of the Internal Revenue Code that says that if assets are inherited or received by gift or what have you from a covered expatriate, then there is a tax payable on those assets. So in a situation like that, it seems to me that renouncing U.S. citizenship could be extraordinarily costly.
Yeah. And you kind of are, that's when you renounce, I would say this, there's many things wrong with the U.S. tax code. But with the estate tax, they did put the exemption fairly high, $12 million for married couples. And that actually that exemption has been rising and rising. And now what it's actually done is, estate planning used to be a thing attorneys did. And now there's not too much of it because there's very few people who have those assets that will exceed that amount. So that is one thing to think about. There are, I would say the U.S. estate tax for U.S. persons is not the worst thing in the world. And there's a lot of ways to plan around that. There are tons of ways to plan around that.
Well, actually, Anthony, on that point, it seems to me, remember the tax residency test for estate and gift is different from income tax. I'm wondering if it might be open to the person. I think I may retract that. Would it be possible to take the position that even though you renounced U.S. citizenship, your domicile was still in the United States? I think that would be tough, but that would be the type of thing that could give the person the benefit of the $12 million exclusion, right?
Oh, wow. Okay. That's something. Yeah.
But anyway, I think, look, as always, and I'm not, being critical, but there's never enough information really to answer these questions. Okay. I mean, this is just, raising issues, et cetera. Okay. Yeah. But I think there's 2 points that need to come through from this. Okay. The first is that if the person remains a U.S. citizen, there are very, very clearly going to be fewer complications, very few on death. Okay. Very few, far fewer complications. The person will have the benefit of the 12 million, what's currently 12 million, but it's going to get down to half of that in, I think, 2026. But anyway, let's say it's 12 million. The person's going to have the benefit of being able to have an estate worth 12 million without any estate taxes, et cetera. If you renounce, the first question when somebody's considering renouncing U.S. citizenship, it seems to me as always, what's your financial relationship with the United States, right? I mean, if you have a lot of U.S. assets, it's going to be more costly to renounce, possibly, okay, depending on how many they are, income streams, et cetera. My guess, okay, listening to this without more information is that the person may want to renounce, but it's probably not the better financial option.
Yeah, understood. Yeah. And I think, and just to sort of to echo your point, that you have if you expatriate, your covered expat taxes sort of start to kick in when your assets are over 2 million. and that is a different, and it's a more punitive tax. The expatriation tax is supposed to be like the analog to the estate tax. However, it's more punitive. It hasn't been adjusted to say with the same exemptions. At some point, it probably was even, but now the threshold for your exit tax is much lower than your estate tax. So that's the thing you have to keep in mind. What makes sense to do. That is that echoing your point, John?
Yeah, I mean, it is. Look, another option here for the person. I mean, I have no idea what this person's net worth actually is, but quite obviously, if there were a way to renounce without being a covered expatriate, a number of these problems would be solved.
Yeah.
So, if you have 3 million, you want to get below 2 million, perhaps you consider gifts, etc. I mean, I don't know. There's not enough facts here, but I think there's two messages here, okay, that need to come through loud and clear. All right. The first is that in considering renunciation, if not the first, the top 2 or 3 issues that need to be considered are what's your financial relationship with the United States? And that means assets owned in the United States, and it means income streams from the United States. Okay. So that's the first issue. I mean, you actually want to prepare a mock tax return, all right, after to see what it looks like.
Yeah.
The second thing that I think needs to come through loud and clear is that renouncing as a covered expatriate is opening the door to a cascading series of problems, okay, that may start with an exit tax payable. And remember that, this is a tax without any disposition or sale. I mean, where do people get the money to pay this kind of tax, et cetera? And it goes on from there, right? Because we talked about the problem of, making gifts or bequests from a covered expatriate to a U.S. beneficiary, right? And that tax. This is a terrible question for, an informal discussion on this channel. But I think the silver lining in it is that, the facts matter. The facts matter hugely.
Yeah.
And that, the person needs to get help. Okay.
Right. You need a lot more details.
And that might, and I think that's generally, I don't know if there's one answer, one question we actually thoroughly answered today. I don't think there is. I think every one of them.
No, there isn't.
More. We kind of need more, but that's not the fault of the person asking the question. That these like, well, oh, okay, wow, all right, I thought I'd get an answer, but now everything kind of rolls in together. There's a lot more stuff to go, which is sort of the bigger problem, how complicated these are. Because a lot of people aren't asking the questions, just going forward. Oh, well, I talked to one tax person, they said to do this, I did that, and oh boy, things happen all the time that go poorly. Now,
can I add something here?
Yeah.
What I'm seeing, or maybe I'm just more conscious of this, so I'm looking for it more. But what I'm seeing consistently is, a lot of do-it-yourself planners who, and the way they approach it is they identify one issue and try to get an answer to that question, without another. And this is not going to work. Okay, this is not going to work. You've got to get all the facts on the table, and they need to be considered comprehensively in conjunction with one another at the same time.
We all look for shortcuts in life, and this is just a place where, it doesn't work. That's what I would say. It would be wonderful if there's easy, quick answers in this stuff. There really would be. And oftentimes those easy, quick answers are incredibly, incredibly difficult to find. And, I want to conclude with, actually, we just got a comment from Suzanne, and it sort of shows the echoing the problem of our first question that we had. of the person. Well, what do I do when, do I have to file or not? And it appears that, Suzanne has a couple comments here, and then we can conclude on this today. Is one problem I ran into when filing my exit tax forms was that when they, meaning the IRS, were not happy with me not filing U.S. tax forms for 10 plus years. Our only income was my non-U.S. spouse, and thanks to FACA, had zero investments. They wanted me to file using my spouse's income as tax. I'm not sure when they're saying they, does that mean their tax professional or the IRS? Since he is not a U.S. person and paid in full taxes here, it was my view not subject to U.S. filing, and there were a lot of scare taxes used. So I'm assuming she's talking about the tax firm that she used. I'm not sure how the IRS would object to that, but that's sort of things that because as the tax professional, I have to file something, right? I have to file something. So here, I'll just put this here so that we have something to do it. But the law requires 5 years of tax compliance to renounce, not 5 years of tax returns, 5 years of tax compliance. And your tax compliance could potentially be filing nothing. That's you have to certify you're in compliance. And so I think that sort of ties it all together there of what we were talking about earlier. Anything to add on this, John?
No, I think you've got that exactly right, Anthony. The language of the statute, you can read it. It's in Section 877 of the Internal Revenue Code. The relevant cluster of words is compliance with U.S. tax obligations. It doesn't say anything about filing anything.
Right.
Now, there may be reasons why you want to file if you want to somehow start a statute of limitation, whatever.
Sure, exactly.
But no, you do not have to file, and that's that.
Right. Keith, anything to add on this? Let's see if we get.
Sorry.
Yeah, Keith. Anything? Oh, sorry.
Yeah. No. I mean, this situation comes up from time to time, where what Suzanne is talking about, and where the spouse does not give permission to share any of his or her information for any type of U.S. tax filing.
Yeah, right.
And that causes a problem.
Yeah.
But obviously, in her situation, she can just do it separate.
All right. Well,
that's it.
I think. All right. So I think we did a great job today. I want to congratulate John. Thank you so much for your insight, Keith, as well. I want to talk about our next Q&A session. I think we might want to do a separate FBAR Q&A because there's so many FBAR issues and that to get to. What do you guys feel about that for next week? What do you think about that?
No, I think it's good because there are a lot of questions and a lot of misinformation out there about FBAR filings. So I think it's a good idea.
All right, awesome. All right, so we'll look for that next week. So we'll be coming to you live next week to answer your FBAR questions. So you can put them in the comments here. I'll check back for any comments that any questions people leave here. So please, in the comments, leave your questions. We'll get to those. We will answer those in next episode. This is Anthony, parent of IRS Medic. I want to thank John and Keith for joining me this morning. I hope we've offered some clarity, and boy, there are probably not a lot of easy answers, but there are answers that are better than others. That's for sure. Everyone, thanks for watching.